Hello and welcome to Macro by Caxelius. I am Victor, and here is a TLDR of today's video using a very simple analogy. Imagine there is a house with a broken toilet, and the toilet is spewing poo and pool water all over the house. Then there's this sweaty person at the doorway trying to scoop all the dirty water into the neighborhood street. Now, the broken toilet represents an ongoing financial crisis in the UK, and the house represents pension funds and big asset managers that's taking a lot of losses because they're warehousing all the toxic assets, holding all the poop, basically. Now, who is the sweaty person? The sweaty person is the diligent Bank of England that's trying to minimize the big fund's losses by shifting the losses onto the British pound. If you find this analogy interesting, please watch on. Putting all the pool references aside, today's topic is the pound sterling's sharp decline versus the US dollar. At 1.10, some investors argue the British pound is a fair value. Yet, there are two reasons to believe why the British pound will face further selling pressure in the days ahead. But first, let's look at the Caxelius portfolio's year-to-date return and why we're so focusing on the pound. Second, a recap on how we got into this mess/opportunity in the first place. Then finally, outlook on the pound sterling. At 14.7% year-to-date, the Caxelius portfolio remains bullish volatility. One part of the portfolio will benefit from further Fed rate hikes, such as bearish equities and bearish sovereign bonds. The other part will prepare for possible Fed policy pivot, such as yield curve steepener and long Chinese yuan versus the US dollar. Caxelius does not advocate for its strategies because they only make sense relative to the firm's own risk tolerance and outlook. Given its bullish renminbi position, the portfolio has an exposure similar to long British pound versus the dollar. Therefore, the portfolio has skin in the game. Our story began in September 2022. The new UK cabinet under Prime Minister Truss announced a £200 billion stimulus program to subsidize household and business energy spending over the next 18 months. Under this plan, utility companies will be mandated to sell energy at a huge loss to their customers. The UK government will then go to hedge funds, mutual funds, pensions, and foreign entities to borrow money. This money will be used to reimburse and repay the energy companies to prevent the utilities collapse. At the same time, the UK government also announced a £45 billion tax cut, which raised markets' fear that the UK's finance will not be in a good shape in the months and years ahead. Not counting UK's fiscal stimulus during the pandemic in 2020, the country's 5-year average borrowing cost was around £140 billion per year. If we use this number and add £133 billion in utility subsidy, as well as £45 billion in tax cut, the UK will likely need to find buyers for £318 billion of its new bonds to get financing. The last chart completely shattered international bond buyers' faith and confidence in the UK's ability to get financing at affordable interest rates. Some asset managers are still willing to lend to the UK and buy their bonds, but they're demanding higher interest rates, meaning higher discount rate and lower prices to buy UK's bonds to compensate them for taking on greater fiscal uncertainties. As a result, UK's 30-year interest rate rose from 350 basis points or 3.5% to 5% in mere 4 trading days. In this chart, many UK pension funds that bought 30-year bonds at prices above 90 were feeling smart, until rising interest rates forced them to liquidate at 42. Massive losses triggered margin calls that threatened to bring down a few highly leveraged pensions and the asset managers. You will find their names in the Bloomberg article in the description below. Name and shame. Facing an acute financial crisis in the making, the Bank of England came to the rescue. The central bank restarted its money printing program and used £8.7 billion so far to purchase toxic assets from pension funds and the LDI managers. This, of course, eased the pain in the pension and LDI industry, and it also slowed down the bloodshed in the UK bond market. Yet, it also socialized the losses to all the British pound denominated assets, meaning everyone's pound sterling in their pockets lost a little bit of purchasing power because of renewed money printing. We're ready for the two scenarios that will lead to further British pound weakness. First, if global energy prices keep rising, then you will force the UK government to borrow even more to subsidize household and business spending. This will add to the fiscal distress and distress in financial markets. Second, if the current market problems develop into a financial crisis, then the international bond buyers will likely not show up to fully finance the UK government's financing needs. This means the Bank of England will be using money printing to step in place of international bond buyers and use money printing to finance the UK government and UK programs. This means the gap between the UK and weaker EM nations would narrow, and the British pound's valuation and EM currencies will converge as well. Finally, let's discuss the couple scenarios that will strengthen the British pound. First, if global energy prices decline, then all the stress and worries about UK finances will just subside naturally, and the pound sterling will just rally back. Second, if the US Federal Reserve stops its hiking due to issues in the US economy or possibly a crisis in the US financial market, then the US dollar would decline versus major currencies, and the British pound would just look better even if nothing is changed in the UK. In other words, currency pair trades are relative value trades. One does not need to look good, the other just has to look worse. With that, we are at the end of our today's program. If you find this useful, please visit again. And if you have questions, please leave them below and I will do my best to answer them. Thank you, and I look forward to see you at the next video. Thanks to our wonderful institutional clients and supporters like you for making this video possible. Please visit our Patreon for daily market updates and live Q&As.